Hey everyone, welcome to our first live webinar. I'm super excited to host this, and joining me is Jimmy Atkinson, who's sort of the father of all opportunity zone and tax benefits in my mind. And so super excited to have you join us, man. Thanks for joining.
Hey, thank you. I don't know if I'm the father of opportunity zones or not, but I think I've created a resource that's one of the leaders in teaching people, particularly high net worth investors, about opportunity zone investing and all the associated tax benefits that go with it. So excited to dive in today and talk about tax benefits for real estate investors.
Totally. All right. So let's dive in, and whoever joins as we move forward will join. Just housekeeping, guys. We have Q&A in the bottom. Feel free to put your questions down there. We'll get to it at the end. And if things are more urgent as we go forward, we'll just answer them. This is going to be just a fun conversation between Jimmy and myself, diving into things that are interesting for me, I think interesting for him as well, and hopefully for all of you. So first things first, the agenda for the call. We're going to start with a short introduction, just a little about Jimmy, a little about me, so you guys get some context as to our background and what we bring to the table. And then I'll give a little refresher about sort of landscape or real estate investing. Then I'll hand it over to Jimmy to talk about tax benefits and Wealth Channel's role in that. Back to me about leveraging Vyzer. And then we'll have a sort of a panel discussion, open discussion, and close it up. Keeping it, we have a lot of stuff to talk about, not a lot of time. So let's dive in. All right. Ready, Jimmy?
I'm ready. Let's do it.
All right. So go ahead and hand over to you.
Oh, thank you. Well, yeah, I'm Jimmy Atkinson. For those who don't know me, I'm the co-founder and CEO of Wealth Channel. And at Wealth Channel, we help high net worth investors grow their wealth with alternative investment strategies. And we really got our start in 2018 when opportunity zones first rolled out. I'm going to talk a lot more about opportunity zones a little bit later during the webinar today, but I was one of the leaders in offering free educational resources, a guide, and a database of opportunity zones and opportunity zone funds to high net worth investors who had capital gains and were seeking the ability to defer those gains into opportunity zone investments. We've successfully been the #1 independent resource for opportunity zones for these last 5 years now. And my Opportunity Zones podcast has over 250 episodes now, and we run an event series called OZ Pitch Day, which we throw 3 times a year, which helps showcase about 10 to 12 different opportunity zone investment offerings at each of those sessions. Now, in addition to that, just a couple of years ago, we founded Wealth Channel. I brought in some new partners to help me launch the new Wealth Channel brand. And instead of just focusing solely on opportunity zones, we have expanded our role to helping investors grow their wealth with all forms of alternative investments, including non-opportunity zone real estate, oil and gas, venture capital, private equity, private debt, you name it. So that's a little bit about us and Wealth Channel. You can learn more at wealthchannel.com.
Awesome. Yeah. And so actually I reached out to Jimmy, I think a few months ago, just dropped him an email, said I love what they were doing with the Wealth Channel and Opportunity Zone DB and all that stuff. Super interesting stuff. And we hopped on a Zoom call and kicked it off right away. And then I was also on his podcast, had a lot of fun. And I thought when we launched this first webinar and want to talk about some interesting stuff that not many people know about, and those that do still have a lot to learn about opportunity zones and taxes in general, I said, we got to get Jimmy on this and dive into it. So I'm really happy you're here. So I'll take it over, just a little background about me. So I'm Litan, I'm the co-founder and CEO of Vyzer. I'm a tech founder, sold a startup about 8 years ago, made some money. And over the course of the past 8 years, me and my co-founder have basically been investing and managing our money on our own, investing in a lot of alternative investments, specifically private equity and real estate, just as passive LP investors. And over the years, sort of made a bunch of mistakes, learned a lot of lessons, and invested in quite a bit of deals. And one of the things that we found out during that whole period is how we want to become passive investors and not be active, and find people we can trust. And through that, also through this allocation into a lot of these investment products, found ourselves sort of in a mess of a lot of investments, a lot of documentation, cash flow, and ended up building a piece of software to automate all that stuff for us. And then a bunch of friends wanted to as well. And it turned out to a new startup. And so that's what Vyzer is about. we're all about helping people like us manage their wealth and keep their passive investments passive. So that's enough about Vyzer. The idea here is to learn as much as we can, specifically from Jimmy. Just before that, I'm going to dive into a little background about the whole real estate landscape and the way I see it and what I've learned from it over the past few years. And I hope this is educational. And Jimmy, like, give me some heat here if you think that I'm forgetting something or if I'm missing something or running too fast. So first of all, real estate investors or investing is a term that is totally ambiguous in my mind, because someone who buys a single family home as a short-term rental is a real estate investor, but someone who invests in a tradable REIT is also a real estate investor, because at the end of the day, both of these people and everything in between has an underlying asset, which is a real estate, right? Agree, Jimmy?
I agree.
All right, cool. And so if I try to sort of put a little more order in the phrase real estate investing, I'll start sort of from breaking it down. So the high level is the asset type of the real estate, which is either residential or commercial. And each of these has their own breakdowns. But overall, residential and commercial, each of these different asset classes within real estate have their own benefits, but also disadvantages sometimes. One is higher risk, one is lower risk, one is more beneficial in terms of taking loans, or easier to get loans or good term loans, higher potential for risk return. Anyway, there's differences within each of these asset types. And if I break them down one more level, it's basically the property type within these asset types, right? So, within residential, we have single family homes, we have condos, we have townhouses. Multifamily is sort of this mix, right? Because multifamily is residential, but it's considered commercial real estate. I'm not really sure why they've considered this commercial real estate, but in a sense, it's become commercial real estate. And when you take loans against it, it's treated differently. And then there's office and retail. A lot of stuff happening now in office spaces. I've heard about buildings now in New York that are being sold by like lower than the actual land that they're built on in terms of the value of the properties. On the flip side of that, if you guys heard about the recent sort of trend of single family new home builds, like we're at an all-time high at that. This past few weeks, we're like 20% up from last month and 5% up from the previous year. So these whole sort of macro and microeconomic trends are affecting these property types differently within the asset class of real estate. So if I dive even a lower level within the property type level, there's a passiveness level. And as an investor, this has become super important to me. When you think about sort of investing in real estate, you can be super active, self-manage a short-term rental, or you can even remote manage a long-term rental with a property management company. Those are different level of passiveness as opposed to investing as an LP in a real estate syndication or in a fund. And obviously, if you go to whatever Robinhood and you want to buy a tradable REIT, that's like ultimate passiveness. You just click a button. So all of these different things are called real estate investments, but they have different attributes. And I think the fourth one, and probably the most important, is the financial benefit. Right? Each of these real estate investment opportunities or possibilities obviously have different financial benefits. Sorry about that. Some of these have higher or lower appreciation potential, cash flow. Obviously, if you invest in a real estate deal that's a development deal, there will be no cash flow, only when it exits. But if you invest in a real estate deal that is a rental deal, you'll have ongoing cash flow. Like, so these are really important aspects to look at when investing in real estate. And then comes the tax benefits, which we're going to dive into more in a second with Jimmy. But tax benefits and liquidity, and there's a bunch of other stuff that come into play when you think about real estate investing. So the important aspect of this for me is that when you think about real estate investing, it's a huge spectrum of investing strategies that are really dependent on an investor's appetite for each of these aspects of passiveness and financial benefits. So I've put those things basically in two buckets, right? For me, when I look at a real estate investment, I want to be on the passiveness level, but also verse that on the financial benefit level. And what that plays out to be usually is sort of if I become more active in a real estate investment, I want to make sure the financial benefit is exponentially better, right? So if I'm more active, let's say, so the story goes like when my co-founder and I first invested in real estate 8 years ago, we bought 2 single family homes with the idea to just long-term rent them with a property management, hands off. And then a few months in, it started to be a mess. Like we get calls from the property management firm and emails from the municipality and just a whole mess of things to deal with. And we wanted to be passive, right? And at the same time, we were also LPs in these syndications, generating better returns and a lot more passive. And at that point, we decided, dude, we want to be passive. We want to make sure that if we move a little more active, the financial benefit needs to be so much better. And so when thinking about investing, and this is all for us, right? Other people might see this differently because they want to be more active. But if they want to be more active, they need to also aim for higher risk return, more cash flow, liquidity, and whatever. And taxes, of course, which I think taxes is something that many beginner investors don't really take too much into account. I didn't take it into account when I started investing, to be honest. And while learning about this as we move forward, it's like, whoa, there's a whole Pandora's box. And I think everyone needs to be really aware of what's out there, what possibilities there are about, so you can take advantage of tax opportunities, of more tax efficient investment products and all that. And so with that, I'm going to hand this over to Jimmy to sort of to dive more into taxes and opportunity zones. Unless there's something I forgot here, Jimmy, you want to add?
No, I think you're looking good there, Litan. Thank you.
All right, man. Thanks.
I'm happy to take it over. Hey, by the way, I also noticed we do have the chat feature enabled just for the panelists, but maybe if you can get into the chat, you should be able to find a setting in there where you can enable it for the attendees as well, because I want to send them some stuff and I want them to be able to send me some stuff too. And then also, just as a reminder, we are going to save some time for Q&A toward the end of this webinar, so please do use that chat once we get enabled, or the Q&A tool. You can submit questions through the Q&A tool as well. One other financial benefit, I know there's there's numerous financial benefits, and you just briefly touched on 4 of them, Litan, but one other one I would say is just kind of looking at real estate as an asset class and comparing it to more traditional forms of investment, namely stocks and bonds. I think are the 2 main types of asset classes that most investors, certainly beginner investors, have in their brokerage accounts or their in their stock portfolios. Real estate allows you a form of asset class diversification, right? So when you kind of think of everything that we talk about today, and you're considering your portfolio strategy, consider your allocation to real estate and what it should be. I guess the typical stock bond portfolio might look like 60-40, seems to be pretty traditional, like 60% stocks, 40% bonds. If you're younger, you have a longer time horizon, you might go 80-20 or 70-30. Maybe if you're a little bit more conservative and you don't want to see as much volatility, you're a little bit older, your investment horizon isn't as long, maybe you're 50-50 or even possibly more weighted toward bonds. But how much should real estate play into that portfolio allocation? Should it be maybe 10% of your overall portfolio or 20%? That's for you kind of to determine on your own, depending on your financial situation, what your liquid net worth is. And I would advise you to, consult with your tax professional or investment advisor before making those decisions. But that's just one more financial benefit, I think, of investing in real estate, is in addition to everything Litan said, it's also a great diversifier against more traditional forms of investment. So let's talk about, I'm going to talk very specifically about 2 different types of wrappers per se on the ensuing slides, namely qualified opportunity zone investing or qualified opportunity funds, and also 1031 exchanges. But before I even get into that, I just wanted to discuss briefly just the overall tax advantages that are associated with nearly all forms of real estate investment. These are in no particular order. Let's just start with the first one, though, which is depreciation. And depreciation essentially means you get to write off a portion of your income each year based on how much your real estate asset depreciates. For residential property, you can depreciate on a 27.5-year schedule. And for commercial properties, you can depreciate on a 39-year schedule. Essentially, you're able to offset income from your real estate assets by depreciating the property every year. And that then adjusts your cost basis. And when you go to sell the property, that depreciation does get recaptured. But even in the depreciation recapture for real estate properties, there's some tax advantages there that aren't built in necessarily to other forms of depreciation recapture for non-real estate property. I won't get into the nitty gritty of that because it's a little bit above my pay grade, first of all. And second of all, we don't have the time and I don't want to get that technical today. But suffice it to say that depreciation is a pretty major benefit of real estate investing. Additionally, there is bonus depreciation that was available through 2022. You were able to depreciate instead of against a 27.5 or a 39-year depreciation schedule, you could depreciate 100% of the assets within the building if you were to conduct a cost segregation study through 2022. The bonus depreciation is still phasing out, actually. So as of right now, in 2023, you're able to take 80% bonus depreciation if you complete a cost segregation study on the properties that you're managing, or potentially if you are investing as a passive investor into a fund where you're an LP or into a REIT. Hopefully the manager is taking advantage of a cost segregation study and taking advantage of these bonus depreciation schedules.
Jimmy, if I can, I have a question on that.
Go for it, yes.
I know that it depends on the asset class, right? Some asset classes have, by definition, 100% bonus depreciation. Some have less than that. And like if the GP can do a cost seg, they always will do that, right? Is there a reason why they wouldn't?
The only reason why they wouldn't is if they don't have the experience or the guidance in order to do it, or potentially if it's a smaller property and it's just not worthwhile. But I would say anything that's a sizable property, and if they have the proper tax guidance from their CPA, they absolutely should conduct a cost segregation study. I will say that depreciation is kind of a form of tax deferral because that depreciation does get recaptured if you then sell the asset for higher than its adjusted cost basis down the road, except in the case of a qualified opportunity fund investment where depreciation recapture gets eliminated. I'll touch on that a little bit more, but let's keep moving on. Let's keep the pace going here. Tax deductions. There's a lot of tax deductions for real estate investment. I'm talking about, just being able to deduct your mortgage interest or your property insurance, just basic things like that. I mean, it's similar to any other form of operating a business, basically, where you have numerous tax deductions that you can take. I think that might pertain more to somebody who's, thinking about leaving their day job and becoming a active real estate investor. Lower effective tax rate via QBI pass-through. So qualified business income, real estate investments do qualify for the QBI rate. So you get to, and this is part of the 2017 Tax Cuts and Jobs Act that President Trump signed into law a few years ago. You essentially get to lower your effective tax rate on income from the investment properties by 20%. You get to write off 20% of your income through that QBI mechanism. I won't get into further detail on that, but effectively it reduces your tax rate by 20%. And then let's see, there are tax deferral and other benefits in certain wrappers. So the two main types of wrappers I'm going to be discussing today are the qualified opportunity fund or opportunity zones and 1031 exchanges, which are similar in many ways, but very different in a couple of other ways. And I've got a slide that has a table on the similarities and differences a little bit later on in the presentation today. Thank you, Litan, for advancing. Perfect timing there. So let's talk 1031 exchanges first. These are known as swap till you drop, is how they're colloquially referred to sometimes. And essentially they are referred to as that because as an investor in investment property that you hold directly, you can continually trade up to higher value properties over the course of your investment career without ever having to pay any capital gains tax, as long as you complete each 1031 exchange within the allowable time frame. And then upon your death, there's a step up in fair market value of all of your properties. There's a step up in basis to fair market value of all your properties. So your heirs essentially inherit all your properties tax free because the basis has been stepped up. So essentially, Uncle Sam never gets any capital gains tax from your your real estate investment transaction history. There are several different types of 1031 exchanges. Well, there aren't several different. There's a few. There's a direct 1031 exchange where you are directly holding the property, active real estate, hands-on, right? And then, so you own a duplex, and then a few years later, you sell it, and then you exchange it for another duplex that's probably a little bit, probably has more value in it. And then you can just kind of do that over and over again continuously with these directly owned and managed properties throughout the course of your career. There was something, and there still is something called a TIC on here, which is a tenant in common. Those really haven't been that popular since the DST came into popularity within the last decade or so here. But TICs are essentially kind of, I guess, a worse form of DST. So I'll tell you what a DST is instead. We'll kind of focus just on DST for that more passive investor on that passiveness or passivity scale that Litan was talking about earlier. A DST is a really great option for somebody who wants the benefits of a 1031 exchange without having the hassles of toilets, tenants, and trash, right? The 3 T's or the terrible T's, as it says on this slide, without having to manage the property, give up all those headaches for, a little bit more passivity. A DST is a Delaware Statutory Trust. The Delaware Statutory Trust came into existence in the late 90s. They've really been popularized just in the last 5 or 10 years now by the real estate investment community as a eligible form of a 1031 exchange. It's essentially fractionalized ownership in a building. So instead of owning an entire building like you might with a direct 1031, you instead are basically in a trust or a fund, it can be thought of, with numerous other investors, maybe dozens or hundreds of other investors. So you now have access to a larger pool of capital. And with that larger pool of capital, you can access institutional quality buildings. So you trade in your duplex or your duplex property, for instance, in this example, and maybe you've got $1 million in total proceeds from that sale. You could buy another property for that $1 million essentially doing a direct 1031 exchange, or you can get access to fractionalized ownership in a building or series of buildings that might have a value of $50 million or $100 million. No matter what you do here, if you want to do well, I guess I'll just kind of walk through this decision tree that Litan's team kind of found here. So the decision tree, as you sell an investment property, you pay taxes, right? Or you can do one of these 1031 like kind exchanges. And if you're going to pay taxes, there's some of the taxes are laid out there. You're going to have a federal capital gains tax. You're going to have net investment income tax on top of that. So it's typically about 23.8%. Then you've got state capital gains tax, which in Texas, where I am, we don't have a capital gains tax, so it'd be 0. But in California, where I used to live, it can get up above 13% pretty quick. And then on top of that, you also have depreciation recapture, which this year is capped at a 25% rate. It all adds up pretty quickly, though, to quite a bit. You can definitely have a 6-figure tax bill or more on a sale of a $1 million duplex in our example here. Or you can do a 1031 exchange, and then you've got the money has to flow through what is called a qualified intermediary or a QI. It's commonly abbreviated as, and you can usually find one of those through your real estate attorney or your CPA, or there's a handful of exchanges online where they'll help plug you in and then you do either an active real estate transaction or this DST, which gives you access to institutional quality real estate, and it being hands off as well. So I think that probably suffices on this slide here, Litan. If you want to move on,
so let me ask.
Next one. If you have questions, go ahead. Yeah.
Yeah. Before I move on, I have some questions because I'm just a passive investor looking to increase my returns and pay as little taxes as I can legally. So here's a question. All right. If there's an exit of an LP position, and let's just say I get $100,000 from that exit, or $200,000 from that exit, and then I want to reinvest that into a 1031, which I'm aware that I can, correct? Like I can 1031 a capital gains from an LP position as well, correct?
Correct.
All right. And then if I put that cash into, I can either go and buy property and 1031 it into an active real estate deal, hands-on, or I can put into a DST. And then that DST, is that like a one-off fund that I invest into it? They have a specific deal that they're going to invest in, and then it's a deal on its own, or is it a fund that keeps on rolling to another property? Like what happens when that fund invests into, let's just buy as a multifamily complex, value adds it 5 years, 7 years, sells it, and then I get more money back? Is that like what happens in that situation? Or
there's different types of DSTs. Some of them are one-off deals where the DST will essentially just be a single asset wrapper that owns one building. Sometimes it might own 2 or 3 buildings. Usually it doesn't hold more than 3 in my experience. And then there will be a holding period where the fund will, or the trust will be illiquid. You won't be able to get your money back. And eventually at some point down the road, you will have some liquidity options if you want to exit that asset. And then you can do another DST where you can pay your taxes at that point in time. So there's numerous types of DSTs, and there's some options for you down the road, but usually there's a lockup period of a few years.
So there's some questions here about the 1031 and all that. We'll just get to this at the end of the Q&A.
Sure.
Let's dive into the next slide, opportunity.
Okay, opportunity zones. So this is this is my favorite one right here. I've kind of branded opportunity zones over the last few years as what I think is the greatest tax incentive ever created. And there's a lot of similarities with the 1031 exchange. You have to start with a capital gain. But as opposed to 1031 exchanges where the gain has to be from the sale of real estate property, with opportunity zones, the gain doesn't necessarily have to derive from a real estate transaction. It could derive from the sale of privately held business, stocks, anything in your Vanguard or Fidelity account that triggers a gain, art, collectibles, even Bitcoin or other crypto assets. And there was a lot of crypto gains in 2017 and 2018 I should say, I'm a few years too early there. I guess 2020 or 2021 was when Bitcoin was hitting new heights. And I did see a lot of investors come into the opportunity zone space with Bitcoin gains. Just kind of a funny anecdote.
Wait,
there.
Did they actually invest in Bitcoin, or they had to convert it to dollars and then invest?
Well, I'm saying Bitcoin holders who had low basis in Bitcoin and then sold in 2020 or 2021, that triggered a gain for them. And then often they didn't have the option of doing a 1031 exchange because it's not real estate property, but they caught wind of opportunity zones as a place where they could defer their capital gains. I just find it interesting that I just love the Bitcoin story. So, but by the way, the same is true with people who held more boring assets, like a privately held business that may have exited in 2020 or 2021, or we had a huge bull market run up before COVID. There were a lot of gains that were locked in 2020 that were sold early on, and just people holding the S&P 500 index funds, for instance. A lot of capital gains out there that could be put to use in opportunity zones. It's a place-based tax policy, meaning that unlike a 1031 exchange where you can, there's no restrictions on the types of properties that you could buy or the location you can buy. With opportunity zones, the federal government has designated certain low-income communities all over the country as opportunity zones. So as such, in order to achieve the benefits of opportunity zone investing, you have to invest into one or more of these 8,000 plus census tracts. They've got that small map of the continental United States in the corner of the screen there. The blue shaded areas are opportunity zones. Each state has dozens, if not hundreds of opportunity zones. There's over 800 of them in California, for instance. There's only 25 in a place like North Dakota, but I think you get the idea. They're rural and they are urban and they are suburban. They are everywhere. They are, for the most part, low income, but a lot of them are gentrifying and turning the corner. And there are a lot of hot opportunity zones that you can invest in as a high net worth accredited investor and achieve these amazing tax benefits. So the three major tax benefits that are available for investors with capital gains: you trigger a capital gain within 180 days, you roll over that gain into a qualified opportunity fund. You get the following three benefits. One, you get to defer realization of that gain until December 31, 2026. So it's essentially an interest-free loan from Uncle Sam for a few years. The big benefit is if you hold your subsequent qualified opportunity fund investment for at least 10 years, there is no capital gains tax once you go to sell your QOF interest or your opportunity zone property 10 years later. So let's say you trigger a $1 million capital gain. You can either pay 200 something thousand bucks in federal capital gains tax, or if you roll it over into a qualified opportunity fund, now you've got $1 million in a qualified opportunity fund. You hold it for 10 years, and then let's say you exit it, 10, 11, 12 years later, whatever, for let's say you hit a 5x. So you exit for $5 million. Now you've got a $4 million gain in the year 2034, let's say. Normally, what's the tax on a $4 million gain? You might be paying about $1 million in tax on that. But with opportunity zones, there's nothing. There's no capital gains tax whatsoever. You get to keep the whole $4 million. Oh, and by the way, depreciation recapture does not exist for opportunity zone investors either. So you can take all of the benefits of depreciation. And remember back a couple slides ago, there's these bonus depreciation allowances that are available now. It's phasing out starting this year, but you still have 80% bonus depreciation available if you do, or if your qualified opportunity fund manager does a cost segregation study. You get a lot of depreciation up front. Is just incredible amount of tax benefits that you get here. So this graphic on the right, which comes from our friends at the California Budget and Policy Center, will show how opportunity zone investments work. Unlike a 1031 exchange where the investor can basically hold the property directly, does have to go through a qualified intermediary, but then the investor holds the property directly, or the investor holds interests in a DST. There's a couple layers here that you need to be aware of as an investor. The capital gains from the sale of an asset have to flow through an entity called a qualified opportunity fund. And that wrapper was created as part of the 2017 Tax Cuts and Jobs Act. So this is, I forgot to mention this, I may have buried the lead here. This is a brand new program, or it's pretty new anyway. It's only been around for about 5 years now. The qualified opportunity fund then has to hold at least 90% of its assets in qualified opportunity zone property. So either businesses within qualified opportunity zone, but more typically it's real estate property within a qualified opportunity zone. And as long as your QOF hits these compliance requirements, then you are subject to all of these amazing tax benefits. And it's essentially the greatest tax incentive ever created, I think, because there's no capital gains tax on the back end as long as you hold for 10 years. I think we've got quite a few questions here, so I might pause there, Litan, if you want to moderate and
yeah,
ask.
no. So I think we'll wait for the questions till the end and
okay,
flow through this. But
do you have any questions?
But I have a quick question just because.
Sure.
All right. So these opportunity zones, right?
Yeah.
You mentioned you can only access them through a fund, right?
Correct.
but essentially these opportunity zones just contain properties, and those properties basically have this incentive that if you buy them and hold them for at least 10 years, there's no tax. Is that accurate? Or is it just a fund that buys a portfolio of properties or builds properties or whatever gets that benefit? Basically, what I'm asking is, can you buy direct a piece of property? Or do you have to do it through a fund?
You have to do it through a fund. But by the way, I've kind of glossed over a lot of requirements here. I've touched upon the high points. But yeah, it has to be through a fund. So if you're a high net worth investor and you're an accredited investor, you have a gain. By the way, I would say in order to do this, you should have a gain of probably at least $50,000 to $100,000 before you even start to consider this, because otherwise I just think the headaches of doing something like this kind of outweigh the benefits. But if you start getting 6-figure or more capital gains, I think this is very worthwhile to look into. It does have to go through a qualified opportunity fund. Now, there's two options there. One, you can find a fund manager that has set up a qualified opportunity fund expressly for the purpose of investing in one or more qualified opportunity zone properties. These different funds have different investment objectives. I've seen, there are dozens, if not hundreds, of these funds that are out there open to investors from money from outside investors, and some of them might focus on a particular type of real estate within a particular geographic area. Others might have a national property type agnostic strategy. They're kind of all over the map here, so to speak. The other option, by the way, is you can, as a high net worth investor, set up your own qualified opportunity fund. If you want to be more active and hold the properties more directly, or if you have, a couple of partners that you want to go in on, you don't necessarily have to be a totally passive LP investor. You could form your own qualified opportunity fund and be the GP. It's very, very possible to do that just for, a few $1,000s to set up your own qualified opportunity fund. There's no acceptance process from the federal government. It's essentially you just form an LLC that files a couple additional tax forms every year with the IRS that says, yes, I'm a qualified opportunity fund. I'm investing in opportunity zone property. That's pretty much it there.
And I think you mentioned in one of our calls that mainly these funds usually do ground up development type deals, right?
Yeah. So that's one of the compliance requirements of opportunity zone investing. Remember, this is a place-based tax policy. And at the heart of the policy is that the government wants to drive economic revitalization into these blue shaded areas on this map here. So you cannot simply buy and hold an already stable cash flowing property. You have to go in and either perform substantial improvement on a property, which is defined as doubling the basis in the value of the building, which is pretty hard to do, quite frankly, or it's ground up construction. You have to build something new and put it into service. So there is some development risk that you're taking on. It's really a capital gains tax play, though. If you have a capital gain and you're looking for capital appreciation, I think it's a great investment strategy here. You're not going to get cash flow right away, and there is some development risk or some rehabilitation risk. And you are investing in areas of the country that have been typically overlooked oftentimes. But if you can get past that, the tax benefits are pretty out of this world, I think.
Cool. All right, that helps. No questions for me, but we'll get to some other questions at the end.
All right.
Want to dive into the next slide?
Yeah, let's do it.
All right.
We're starting to run out of time here. So this one's pretty beefy. I'll kind of go through these pretty quickly, but I wanted to kind of compare and contrast opportunity zones with 1031 exchanges and DSTs. By the way, we really just glossed the surface here. We don't have a lot of time. We'd probably need like a 4-hour course to go into great detail here. So, but hopefully we'll get some questions answered toward the end. But on the left side, the investment aspect, and then we'll talk about what OZs looks like, and then we'll talk about what 1031s look like. So the full tax benefit, the timeline, an opportunity zone, you just have to hold for 10 years and then you get the full tax benefit. Whereas with the 1031 or DST, the full tax benefit really doesn't kick in until you pass away, and then it passes on to your heirs, who get to step up the basis in all of your properties to fair market value. That's that's essentially the full tax benefit. Although as the primary investor before death, you get to avoid capital gains taxation. You get to just keep kicking the can down the road, essentially. So just something to think about there. Triple net leasing is a common strategy with 1031s and DSTs. It's allowable there. With opportunity zones, it's unfortunately not allowed. There is a caveat there. I think you can have a portion of your opportunity zone activity devoted to triple net lease type properties. But again, the government here is trying to catalyze economic revitalization in these areas. So simply going in and buying a like a Walgreens or a Dollar General or some other property like that that's typically done through triple net leasing is not allowed. They want you to build something new or improve property. Investment eligibility. I spoke upon this briefly. If you have a non-real estate gain, a 1031 or a DST is not available to you. If you want some sort of deferral strategy, you really want to look at opportunity zones as your only option among these two choices. If you have a real estate gain, then you can kind of take a look at either option. You can take a look at a 1031 or DST, or you can take a look at opportunity zones. Both of those would be available to you. The investment amount, this is a pretty stark difference here. The amount you have to invest in order to get the full tax benefit. With a 1031 or a DST, you have to roll over the entire sales proceeds, both the principal and the gain from the sale of your previously held asset. With an opportunity zone, it's only the gain amount that is eligible for these tax benefits. So if you sell a building for $1.5 million and $1 million of that is the gain, with a 1031 or DST, in order to get the full tax benefit, you have to roll over the entire $1.5 million amount. With opportunity zones, you get to take $500,000 off the table. You can do with it whatever you want. That's your basis in the building or your principal in the building. Only the $1 million gain you have to put to work in an opportunity zone investment. So there's a little bit more flexibility there. And I know by the way, that's a very simplified example. So Jimmy, I'm glossing over a lot of things, but go ahead, Litan.
So Jimmy, I think because we're running out of time, we do have a bunch of questions. I mean, this is really amazing stuff, and I think we're going to share this anyway. Let's
share it with everybody. Yeah.
And let's start. I think we should just skip over to the Q&A.
Let's do it.
I mean, we said some stuff about the wealth channel. Unless you want to add something short about that. Anything?
Yeah, just one thing I'll mention is, this is what we do at Wealth Channel and at our associated property, the Opportunity Zones database, opportunitydb.com. We help high net worth investors grow their wealth with opportunity zones and other forms of alternative investment strategies. We have free online resources, podcasts, and events. Our next event coming up is our Opportunity Zone Pitch Day event. It's free for investors to attend that, and it's on July 20th, just a few weeks out from here. You can learn more about our events at wealthchannel.com.
Cool. Yeah, and so Vyzer, basically, where we help people that are invested in stuff like this that we've been talking about, sort of track, manage, and aggregate everything into one place, basically serving as our one source of truth for tracking, managing, and controlling their wealth. We analyze all your documents, all your emails, Excel spreadsheets. We'll connect to all your investment platforms, cash accounts, and track performance, and project returns, and all that stuff. And Vyzer.co. Anyway, the important stuff. Let's dive into questions. All right. So, man, I feel we could have talked about this for a lot more time. So, all right, I'm going to start from the top here from the Q&A. So Thomas Clark had some questions here, and I'm not sure if I think we covered this, but I think we need to go a little more basic and explain sort of like the difference between a DST. What's a REIT? I'm assuming that's a REIT, right?
I would assume that he means REIT there.
And a real estate syndication group. So when we talk about passive investing, right, we're talking about someone like me who has some money and I want to invest in real estate without actively going and finding a house to buy. And I'll leave DST put aside for a second. A REIT basically is I can go online to my brokerage account and buy a company that's publicly traded but owns and operates real estate investments. That's a real estate investment trust. And those are online, they can be publicly traded or privately traded, but the idea is that you can go into a publicly traded company and buy their stock. And they distribute dividends and all the stuff that you would get benefits from real estate with an underlying asset of real estate. There's liquidity and stuff like that. And the way I see it, the price of the REIT, which is traded online, doesn't always reflect the underlying asset. It reflects the supply and demand of that specific stock. So that's REITs. Real estate syndications, that's what I've been doing for the past 8 years. Basically, imagine a group of people get together, they go and buy a multifamily complex. In that group, there's a person or company that goes and finds the deals, goes to the bank and gets a loan, and they raise money from people like me that just want to put cash in and get distributions and have no liability. Limited partner, that's an LP. General partner, the GP that goes finds the deals, that's a real estate syndication. And a DST, you want to just like shed some light on that in this sort of like more simple terms, Jimmy?
Yeah. Well, so yeah, I think you did a great job explaining what a REIT is and what a real estate syndication is. I use the terms real estate syndication and real estate fund and private placement offering kind of interchangeably. There are some distinct, I mean, there are subtle differences between those three different terms, but I don't know that they're really distinctly defined. So I would say, I would kind of say a DST is a form of a real estate syndication in which, you get these tax benefits. It's a type of syndication that is eligible for a 1031 exchange. That's kind of how I think of it, about it.
Right.
Anyway.
Yeah. Basically, yeah. So you get profits from an LP deal you did, and you want to put them in a place where you don't have to pay taxes yet. That's a DST, for example, and they'll go buy different type of multifamily complex or any type of other real estate deal. So that's difference. All right. So there's a question here about how depreciation recapture works. And I think you mentioned that when you spoke about the opportunity zone advantages where there's no depreciation capture.
Yeah. So I guess I can walk through an example here. You buy a property for $1 million. And then let's see, you hold it for 5 years, let's say, before you sell it. This is just maybe this isn't even a tax advantaged holding wrapper that you have it in. Each year that you hold that $1 million property, you get to depreciate it by a certain amount. I'm going to make up the numbers here, and they're not going to be accurate per the IRS schedule, but let's say you get to depreciate it by, what would be a good example here? Let's say you get to depreciate it by $25,000 over the next 4 years. We'll make the math easy for me. Then at the end of the 4 years, you've depreciated it $25,000 a year. So your $1 million property that you acquired, its adjusted cost basis when you sell it 4 years later is now $900,000, right? By the way, each year that you depreciate it by $25,000, you get to offset that against the income that the property brings in. So it essentially offsets your tax liability, not your tax liability, your income by $25,000 per year. So it lowers the amount of taxes that you have to pay. Okay, that's step one of depreciation, right? That's kind of the big benefit there. When you go to sell the building after holding it for 4 years, and now the adjusted cost basis is $900,000, you go sell the building at a gain of, let's say you sell it for $1.1 million. Okay. So what's your gain amount there? Is it $100,000 or is it $200,000? Well, it's both actually. So you actually have $100,000 in depreciation recapture plus a $100,000 additional gain there. I kind of feel like I need a whiteboard to keep track of all these numbers. Sorry, we didn't get that set up for this one. But then then those two different gains get taxed differently. So your $100,000 worth of depreciation recapture is taxed at, I believe it's capped at 25% this year. It kind of depends on your income bracket though. And then you would, in addition to that, you would have $100,000 capital gain as well, which would get taxed at a different amount. Did I answer the question? I think that's basically how depreciation recapture works. Now, for the benefit of an opportunity zone transaction is, let's say all else is still equal, you were able to depreciate it $25,000 a year for 4 years. Well, I guess you'd have to sell it after 10 years for an opportunity zone transaction. So let's say you depreciate $25,000 over 10 years. So then the adjusted cost basis is $750,000 now, and you go to sell it for $1.25 million 10 years later. You've got this $500,000 gain, half of which is depreciation recapture, half of which is capital gain, 250, because I kept the math simple. But with opportunity zones, you don't pay any capital gains. So your capital gain is essentially zero. And you also get to avoid depreciation recapture. So your depreciation recapture is zero, and you basically owe zero tax there on that type of transaction. So hopefully that was helpful. And sorry I didn't have a whiteboard. That probably would have made.
I think it was good, and I think Mohammed should also talk with the tax advisor as well, just to make sure he.
Oh yes, yeah. Also, everything we have said today is for general information purposes only,
Exactly.
and please consult with your tax professional before making any investment decisions.
Exactly. All right. Douglas here has a question. If he holds a rental property till he dies, should he be indifferent between a 1031 or opportunity zone fund, because his heirs will receive a stepped up basis in either event?
Yes. Let me read his question one more time. Should I be indifferent between 1031-OZ, or maybe 1031 is better because I don't have to sell by 2046? Yeah, in that case, the 2046. So yeah, opportunity zones do have this end date where you have to. I thought it was 2047. But anyway, in any case, yeah, you're in the ballpark there, or I'm in the ballpark at least. I don't know what they're going to end up doing with that end date. That's a good point, Douglas. I would say that if you are going to hold until your death, maybe there's a little bit more certainty with how a 1031 gets treated. I think you might want to lean a little bit more toward 1031 in that example, but otherwise, yeah, I don't know that it really matters all that much, quite frankly. Good question there, Douglas.
Wait, can you 1031 into an opportunity zone fund?
I don't know that you can. That's a good question.
That's like double dipping, right?
That'd be a question for
the system, right?
That'd be a question for a CPA, yeah.
All right, cool. And Thomas has another question here. So there's a mixed use 18 apartment unit opportunity zone. If the restaurant or retail, does the historical aspect give you additional tax savings? I'm not sure.
Yeah, so I think I kind of see what Thomas is getting at here. So yeah, opportunity zones are kind of like its own tax incentive, right? But in addition to that, opportunity zones can be paired or coupled with multiple other types of tax credits, either federal tax credits or local tax subsidies. They can be paired with what are they called? TERS or TIF, tax increment financing. Yes. So you kind of can look at an opportunity zone investment as you would any type of real estate investment, where you have a capital stack where a portion of it is equity, a portion of it is debt, and a portion of it is other types of tax subsidies or tax credits. So in this example, that particular property might be eligible for a federal historic tax credit. And, I would look into that. There's no reason why you can't have some historic tax credit money flow into part of the capital stack, in addition to opportunity zone equity flowing into a different part of the capital stack. That's a good question, Thomas. I have seen some folks do both. It's not easy to do, but it is doable.
Cool. All right, over to the Q&A here, because that was just a regular chat.
Yeah.
We answered these first two. All right, now Yoel, who I don't think is here anymore, well, let's answer the question anyway. So can you, he didn't know that you can 1031 from an LP sale.
By the way, I don't know that you can. I'm thinking about that. I don't know that you can. You kind of caught me off guard with that one, I think, Litan, because I'm not sure. I'm not sure if you can, because I don't know if that would qualify as a like kind exchange, because I think LP interests might be considered personal property. So then I don't know that you could 1031 an LP interest into a 1031 exchange. I think Yoel might be onto something there. I think he might be right. I think you do have to hold the property directly in order to do a 1031 or a DST.
But hold on. I know for a fact that there are GPs that paint their deals as 1031 type deals that you can invest as if they are a 1031 as well. And so, or if I have cash, I can put, for sure. I know that people have sold me on a deal that I can invest in, and it would be a 1031 tax haven. At least, maybe not the proceeds, but if I sell property, let's say active property, and then invest the proceeds from that into an LP deal, I can do that for sure. Like, that's what I've been offered. At least people were lying to me, but that's what I've been offered.
No, I think that is eligible as long as it's set up as under a tenants in common structure or a DST structure. Yes, I think it was going the other way though. I think it was,
well, if it goes one way, can it go the other way as well? I mean, that doesn't make any sense. Why would it go one way, not the other?
Well, now you've caught me out over my skis.
All right, I'll check. So I'll look into that.
That might be another one. That'd be a good question.
Yeah.
That's a tricky one. I don't know if you're just let me think about this. If you're in a private real estate fund as an LP and you exit that, are those proceeds eligible for a 1031 treatment? I don't know the answer to that. If it's not a TIC or a DST, it might not be, but that might be a question we have to research and find the answer to offline.
Well, yeah, I see Clint here just wrote us, no on the LP interest, the partnership has to do it. I'm not sure exactly. If the partnership has to do it, then the GP should do that for me as the LP, right? And I see Proma De Beer also ask the same question. You can 1031 gains from being an LP in a real estate equity, private equity fund. Can you do this 1031 by reinvesting back into another? Yeah, well, this is exactly what we're asking now, because again, I've been offered to invest my proceeds into an LP deal and take benefit of a 1031, and it was not painted as a DST. And so I guess we need to dive into this, and I promise to share my findings with anyone who's on this chat and webinar over email, and maybe we'll all learn some more stuff.
Yeah, I think it depends how that LP deal is structured, that private equity fund is structured. Is it structured as a TIC or a DST or not? Because I'd be curious to learn what your findings are.
We got some homework. We got some more. Yeah. Anyway, so yeah, we have 2 minutes. So listen, let's wrap it up. I don't see any more questions here. Jimmy, this was awesome. I love talking with you. I learned a lot, and we have more questions going out than we went into, but that's always good as well.
That is good. We might have to do a follow-up one of these at some point.
Yeah, totally. I promise to follow up with this. So really great to have everyone here on the call. We're going to share the recording of this webinar with everyone who registered, signed up. You guys can reach out to Jimmy. You want to tell everyone how they can reach out to you, or we can say it out loud and we'll share it anyway.
Yeah, you can reach out to us by emailing info@wealthchannel.com, or just visit our website, wealthchannel.com, and you can kind of find us there.
Awesome. And I'm Litan, Litan at Vyzer.co. And you guys can reach out to me and my team. We're always happy to answer questions, talk with LPs, see how we can help. And hopefully we'll have some more of these awesome webinars with people awesome like Jimmy. Thanks so much for joining us, and we'll be in touch.
Thanks, everyone.